The April preliminary consumer sentiment index published by the University of Michigan is at 47.6, the lowest level in the survey's 74-year history. What is happening? Why is the consumer sentiment index so low? And what can we expect from the economy and consumer strength going forward? Joanne Hsu joins us today. She is the director of the surveys of consumers from the University of Michigan, and her team is responsible for putting together these surveys and indices. Welcome back to the show, Joanne. Good to see you as always.
Thanks for having me.
I want to show a chart of this consumer sentiment index and just show how bad it is, but just explain to a layman from an economist perspective what's happening right now and how bad really is it compared to previous readings.
I think that the context that's really critical for this is that consumer sentiment has been relatively low for more than the past year at this point. Sentiment has pretty much been treading water for the past year. It reached a trough at the height of the tariff developments from last April, Liberation Day. It improved somewhat thereafter, but those improvements didn't really stick. And it's not really any sort of surprise what's going on right now. Consumers have been loud and clear over the last few years that their number one factor weighing on them is the persistence of high prices. And of course, what happened in March and April, it's the war in Iran. Consumers are very concerned that the developments, those geopolitical developments, are not going to help on the inflation front. In fact, they believe it's going to make it considerably worse.
At the same time, stock markets are now rebounding and the S&P 500 is nearing new all-time highs again. And when you think about it, stocks go up when analysts and the investment community alike think or expect earnings or profits to improve. Now, there's two ways to do this. Either you can cut your costs, in which case profits will improve, or there's better demand and better sales. Better sales will come from consumers. And so if consumers are feeling weak, why are analysts and the markets feeling better, therefore pushing markets to new all-time highs? How can you reconcile this?
Well, I think what's going on with consumers and analysts is it's not really quite the same thing. With stock markets, that's actually something that some consumers do pay attention to. When we look at consumers with large stock portfolios, over the last few years, their sentiment has improved from troughs. They recovered very quickly from the Liberation Day tariffs. At the same time, people at the bottom of the wealth distribution, they are the ones who are really pulling sentiment down because they're just really, really weighed down by these high prices. Consumers aren't nearly so optimistic about the anticipated productivity gains from AI. They are seeing quite a bit of weakness in the economy right now, which we're seeing with weaker labor markets. It is absolutely the case that labor markets are nowhere as dynamic or as robust as they had been in the immediate post-pandemic period. And really, consumers are paying more attention to kitchen table issues than anything else. And on those two fronts, on prices and incomes, they tell us that they are struggling.
This is a longer term chart of the same index here. And my first question looking at this chart is, have you and your team changed your methodology for collecting data or changed the questions in the survey? Because it's worse than 2008. It's worse than COVID. It's worse than the dot-com bubble. It's worse than the 80s recession. Well, not quite, but about the same level. And it's like we're not in a financial crisis right now. So how does this make sense?
So we've been measuring consumer sentiment since 1946,
Right.
And the world has changed quite a bit over that period. The fundamental questions that are part of the index related to personal finances, business conditions, and buying conditions for durable goods, both in the present as well as the future, those questions have not changed during this entire period. That's been stable. But we have had several methodological changes over this 80-year period. We were originally a face-to-face survey. We had our interviewers knocking on doors in the 40s, 50s, and 60s. We eventually became a landline survey. And as people stopped using landlines, we switched to cell phones. And now people don't really answer cell phone calls from unknown callers. And we switched to interviewing via web. So periodically, we've needed to refresh our methodology in accordance with changing technology and changing cultural norms. So that isn't really specific to the current period. But I do want to say that a lot of things have actually changed in recent years. with the pandemic, we had a lot of traditional economic relationships kind of fall apart. The inverted yield curve, leading indicator for recession, that did not work after the pandemic. The SOM rule indicated a recession, which did not come to end up being the case. And there are many others. So, there are a lot of things that since the pandemic have changed. On the consumer front, we know that mental health, particularly of younger people, has deteriorated since the pandemic. We know that trust in institutions, views of the government, the increased polarization. There are things that have deteriorated about how Americans see the world around them. That's not really specific to the economy. That being said, when we look at trends, I think surveys are still really important for understanding changes in views of the economy. The last time we had a number, the second lowest number that we had on record was June of 2022. And that was at the height of post-pandemic inflation. And since then, it is true that inflation has softened, but it's still above the Fed's target. And labor markets are unambiguously weaker than they were in 2022. So I don't think it really should come as a shock that, after the pandemic, people were feeling stretched on the expenditure side, but labor markets were incredibly strong. So they weren't feeling stretched on the income side. Now they're being stretched on both, and we have a war.
Right. And I will say that the University of Michigan Consumer Sentiment Index is one of the most influential indices for consumer sentiment out there, along with a few others. Economists and analysts and investors, fund managers alike, on my show at least, all regularly cite it as part of their decision-making process. If a fund manager were to say to you, Joanne, I think consumers are about to spend a lot less money and I'm allocating my portfolio accordingly because of the data presented in this survey, how would you respond to that? To what extent does this survey actually match consumer spending going forward?
I think that our data are clearly showing some red flags with respect to consumer spending. Consumers are flagging multiple risks. So in the post-pandemic period, when sentiment was low, and it is true that consumer spending was high for a period of time, in 2022. But at that time, even though consumers felt terrible about the economy and they were frustrated with inflation, they had strong incomes to support that. And in more recent years, they've had strong asset values and currently have strong asset values. However, we no longer have that incredibly strong labor market that will support robust spending despite negative feelings about the economy. And I think we are really a forward-looking indicator for the economy, for the consumer. And we are seeing signs of weakness in a lot of different other indicators as well. We're seeing elevated delinquencies and elevated usage of credit. That's certainly not going to be a good sign. We have very low savings right now accordingly. And so consumers are in a precarious position. And we have been seeing a slowdown in consumer spending in recent months as well. People have been talking about the resilience of the consumer in the post-pandemic period. And I don't think we can count on that. Consumers are just highlighting too many points of weakness. I think the one, bright spot, of course, is strength in asset values, but that only benefits consumers who hold substantial holdings. If you don't have large portfolios that are allocated to these higher valued assets, you don't really benefit anything from a rising stock market. So I do think we might be able to depend on continued demand from higher wealth, higher income people. But I don't think we can depend on the rest of the distribution to hold things up as well.
Before we continue with the video, let's talk about a topic that's been on a lot of precious metals investors' minds: how to generate income with your gold holdings. Most assets either generate income or rely on price appreciation. Gold has traditionally fallen into the second category. Our sponsor today, Monetary Metals, has found a way that lets gold do both. Instead of just holding gold and waiting for price moves, investors can now earn a yield on it paid in physical gold. Through the leasing platform, investors can earn up to 4% annually with yield paid monthly in ounces. That means your holdings increase in gold over time. The metal remains in your asset base and can be redeemed at any time. Thousands of investors are already earning monthly interest in gold through Monetary Metals. So visit monetary-metals.com/Lin in the link down below, or scan the QR code here on the screen and make the most out of your gold today. Even for those people who do hold portfolios and investments, how much of their spending depends on the valuations of those portfolios? Has research indicated a clear relationship between the value of your investments and actual spending? In other words, is the wealth effect real, according to your research?
The research the best research that I'm aware of does show some role for the wealth effect. It certainly is not the case that consumers are going to pay or spend dollar for dollar what their portfolios look like. They are going to be spending dependent on their expectations for the future. Do they think that these asset values will remain high? But regardless, it's unambiguously the case that if you have a large portfolio, and that doesn't need to just be stocks, it could be your house as well, you feel more safe or you feel more secure in the ability to take risks, and that those risks might include spending a little bit more than you're comfortable with. And so there is a wealth effect. Different scholars will disagree if it's large or small, but we do know that that wealthier people do generate a disproportionate share of spending, and that's one of the reasons why the weakening consumer might be a little bit harder to see in the aggregate data. But again, when we disaggregate our survey data, it's very clear there are many consumers who are struggling right now.
Let's take a look at this chart, and maybe you can help us make sense of this. The dotted line shows year ahead inflation expectations, which have been going down, and the red line shows the percentage of consumers citing high prices for poor personal finances on a 3-month moving average, and that's been going up. Can you help us make sense of this spread here?
Absolutely. So I want to give a little bit of historical backdrop for this. So the red line, again, is a percent of consumers who are telling us that high prices are weighing down their personal finances. Historically speaking, when you go back to the 60s and then 70s and the 80s, that red line moves pretty much in step with inflation expectations and realized inflation. It went up when inflation, that share consumers blaming high prices goes up when inflation is high. It comes down when inflation slows. And that actually now looks very different. You see both of these lines being pretty low in the late 2010s and then climbing together along with actual inflation in 2021 and 2022. And then this is where the divergence that I want to highlight shows up. After 2020, the peak of inflation in 2022, you see inflation expectations come down. They rise again with the tariff announcements, and they've come down. The red line, in contrast, it never came down from that 2022 peak. It has stayed up throughout this entire post-pandemic period. Consumers, even though they are fully aware that inflation has slowed and that the tariff inflation that they feared, that worst case scenario didn't come to fruition, they're still extremely frustrated by the pain of high prices. And also note those two dots on the right-hand side, that those are readings from after the start of the Iran conflict. So both complaints about high prices as well as inflation expectations, they both surged right after the start of the Iran conflict.
If I were a part of a household that participated in the survey, and I think that higher prices are weighing down on my spending, and I think inflation is going to remain persistent and be a problem, would I be more likely to spend now or later? Because if I think prices are going up again next year, wouldn't I want to buy that refrigerator or TV now and actually contribute to economic growth?
Yeah, that's a great question. So not only would that contribute to economic growth, that would also contribute to higher inflation in the long run, right? Like it is both a positive factor as well as a negative factor for the economy. So what's really interesting is that even though short-run inflation expectations went up substantially after the start of the Iran conflict, long-run inflation expectations only nudged up just a little bit. Now that might change when we put out new data on Friday, next Friday. But the most recent reading, most of the increase in inflation expectations was limited to the short run. So there may be people who may be fearing inflation right now, but may believe that when it comes to big ticket items, if I don't need it right now, maybe I wait a year. If I wait a year, by then we believe I might believe that the conflict will be over and maybe inflation slows down again, and that's the right time. And I think that is the likely situation right now, because people don't feel confident in their incomes to go out on a limb and make a major purchase now. But that's something that I'm monitoring very closely. We do have specific data in the survey that speak to inflationary psychology. So we ask about buying conditions for durables, cars, and homes, and we track the share of people who say you should buy now to avoid price increases in the future. So this is the front loading of purchases that could create greater demand now, as well as upward pressure on inflation. We're only seeing a little bit of that. We're not seeing any sort of surge like we are with short-run inflation expectations. So at this time, consumers are bracing for pain from the Iran conflict, but they're not necessarily expecting that pain to persist into the long run, and by which I mean 5 years or more down the road.
The April report came out during the Iran conflict. Now, that contrasts with the previous reports which were published before, or at least the data was gathered before that war broke out. And so what have we learned about the speed of transmission between an actual conflict or geopolitical shock versus household psychology?
So in terms of the inflation expectations, in terms of sentiment and expectations for the future, that changed pretty much immediately. We saw a pretty sharp break in sentiment as well as inflation expectations immediately after the start of the hostilities in Iran. Starting March 1st, I think the military activity started on the 28th. We started seeing in the data March 1st, and it continued to climb. The first thing and the biggest change we saw were in gas price expectations, and I think that's very consistent with the actual geopolitical risk. The primary risk, immediate risk from conflict in the Middle East is with gas prices. And indeed, that's what happened in real life. Gas prices started responding immediately. Consumers, of course, noticed that. And so we had gas price expectations double, triple in those immediate days after the start of the conflict. Consumers aren't necessarily confusing that, though, with prices in general, right? So inflation expectations did not triple. So we had, consumers are fully aware that gas prices aren't everything, but it is still going to be a big part of how they view their personal finances. And part of that red line we were just showing before on consumers blaming high prices for dragging down their personal finances, a lot of that is gas prices.
How does your survey pair with, I guess, other economic outlooks? So this is from the IMF, and let me just share this with you. This came out recently. Their World Economic Outlook, and I just want to read this paragraph. Our adverse scenario assumes further disruption leading to higher energy prices and inflation expectations and tighter financial conditions throughout the year. Growth falls to 2% this year, and inflation rises to 5.4%. I think this is talking about global growth, not just in the U.S., and I know you measure consumer sentiment in the U.S., but does this more or less reconcile with the survey that you've presented here?
It's highly consistent with what we're seeing from consumers. Consumers are broadly expecting a slowdown in the economy, in the U.S. economy. They're expecting inflation to be higher, at least in the short run. Consumers feel pretty sure that the economy is going to weaken in the year ahead. Again, long run expectations didn't move nearly as much. I think consumers are still reserving judgment on what that's going to look like. And I think that makes sense given how much uncertainty there is on how long it's going to take for this conflict to resolve. But more specifically, how long is it going to take for the Strait of Hormuz to open up and for the supply disruptions coming from this war to unwind? So given that uncertainty, I think it makes sense that consumers really don't feel confident about the short run. And I think that is very consistent with what the IMF is reporting.
Joanne, what's next for the Consumer Sentiment Survey? What will turn it around is my question.
It really depends on these supply disruptions in the Middle East. So I think even if there is a longer term ceasefire, if that ceasefire is not accompanied with a reopening of the strait and unconstrained shipping, we're still going to see elevated gas prices. a long duration of elevated gas prices will be more likely to pass on to overall inflation than, of course, a short run disruption to energy prices. And so the longer the supply disruption persists, the longer consumers will feel negative about the economy. However, if these supply disruptions go away quickly, I see consumers recovering, particularly if they start feeling confident that these spikes in gas prices are spikes and are not permanent shifts up and won't necessarily translate to other prices they pay.
This is from Ken Griffin, Citadel CEO. Let's assume it's shut down. He's talking about the Strait of Hormuz. Let's assume it's shut down for the next 6 to 12 months. The world's going to end up in a recession. There's no way to avoid that. Do you agree, broadly speaking?
I mean, I think a long run supply disruption is going to be challenging for the world economy. I'm not enough of a trade expert specifically in the trade going through the region to, pick a cutoff, how many days is it, or how many months is going to be the critical factor, how many weeks at what price of crude oil will be the factor. I can't really opine on that, but certainly the longer that supply chains are disrupted, the bigger the impact on the rest of the economy, and the harder it's going to be to dig ourselves out of that. We know that with the oil industry, anything that is shut down because things can't ship, it can't just be turned on like a light switch. It takes weeks, if not longer, to get back up and running. And I think the big open question for consumers and consumer spending is how much pass-through are we going to see to other consumer-facing prices? Suppliers, producers can only eat these higher fuel costs to an extent. They're already passing some of them through to consumers, and consumers don't feel confident about their income. So they don't really feel equipped to absorb all these, to absorb higher price hikes. So we are at risk for a kind of a negative cycle, a non-virtuous cycle, if you will, in which constraints can in supply chains can lead to constraints for consumers and for the economy as a whole.
I'm just musing here. To what extent do you think social media and the internet is responsible for lower consumer sentiment versus a few decades ago? People are online 24/7, not 24/7, but you know what I mean. They're always on their phones, they're always on the internet watching this, and they see a headline like, oh, Ken Griffin from Citadel thinks the economy is going to go down the gutters. I should probably start to worry myself. Whereas this information was probably less accessible to people in the 80s. You have to open a newspaper and watch cable news or whatever. So I don't know if lower consumer sentiment is just going to be the new norm going forward because of technology. This is just a theory. What do you think?
So we've done a little bit of research on that. I've collaborated with professors in the Department of Communication to understand what news sources consumers are using when they form opinions about the economy. And what the communications professors tell me is that, as I mentioned at the beginning of this podcast, views of a lot of things have become more negative, and social media is part of that. When we began the survey in the 50s and the 60s, everyone got their news from the same place. It was the daily paper, the same radio stations, the same TV nightly news. Everyone got their news at the same time. And you only got it a couple times a day. And that changed with 24/7 cable news. And that and the onset of cable news in the 90s did lead to a bit of a polarization in consumer views. We had a much stronger reaction in sentiment and views of personal finances to the brief period of inflation we saw during the Great Recession. That really was disproportionate relative to the shocks that we were seeing in the 70s and 80s. And then it's not just social media, right? Like social media has been around for 20 years now. What the communications folks tell me that it's actually really about the algorithmic newsfeed. And that was in the late 2010s, where it was no longer social media just serving up what your friends liked, what your friends are posting in chronological order. Now the algorithm is predicting what will generate the most engagement based on what everyone else is engaging in. And that might have nothing to do with what you would choose to post or what your friends are choosing. And that really polarizes what people are seeing. And it also means that everything that they're seeing is emotionally triggering because it's designed to be that way. That's what generates more clicks. So it is true that I think negative views of the economy are going to be influenced by the social media landscape and also the traditional media landscape, though there aren't as many people paying attention to traditional media than there were before. I'm not saying that social or traditional heritage media is causing these negative views. It could be that if you're already frustrated by high prices, you click on every single piece of high price
That's right.
posts or media that you can find. So, but it seems very likely that it's self-reinforcing. So, I think we are in an era of diminished expectations. I think it's hard to imagine a situation where consumers feel really vibrant about the economy. And that's why I think it's not necessarily useful to compare the level of sentiment today versus the previous troughs that we might have seen 15, 20, 30 years ago. The world is different, the people are different, the generations are different. But the trends, I think, upward trends still mean an improvement. Downward trends still mean a deterioration. And it's very clear with this Iran conflict, consumers think that things have worsened.
I wonder how much of the consumers' financial positions have changed. We talked about sentiment and how they feel about the future, but I'm just looking at a few indicators. This is not comprehensive at all, I know, but This is the delinquency rate on credit card loans, for example. That's been coming down, hasn't been going up. If you look at the consumer loans, credit cards, and other revolving plans on a percentage change basis, it's spiking up a little bit, but it's not at the same level as it was in 2022. It's not at the same level as it was before 2008. In fact, during recessions, these loans actually come down, not up. So I wonder if this is, I don't want to sound facetious, but this is all in people's heads, but their financial positions are getting worse. Do you have any data to support this?
So there's recent research coming out of the Philly Fed that points out that it's not necessarily the case that slight improvements in these credit indicators are an indicator that households are doing well, because this is an intersection of both what consumers are doing as well as what lenders are doing. And lenders have the ability to cut off credit to people they think are higher risk. And that's precisely what these researchers believe is happening in these recent quarters, in these recent years, that when you see an improvement, it's actually confined to people in higher income areas. And we're not seeing any improvement at all in lower and middle income, among lower and middle income families. They're just being shut out. So they're not even in the data to begin with. So, I do think that when we're looking at national data like this, and our data included, it's important to kind of look under the hood a little bit, because different consumers are experiencing different things. And like I said, people with large stock portfolios, they have been looking very different in our data than people with smaller or no portfolios at all.
We'll finish up in just a few minutes, Joanne, but this is the report that was published in April. Demographic groups across age, income, and political party all posted setbacks in sentiment. Now, we talked a lot about sentiment regarding inflation and prices and setbacks in financial conditions, but why have we not discussed the labor market yet? How are consumers concerned about getting laid off? I'll give you a personal anecdote. I just interviewed a guest before you. His niece is at Harvard Medical School, and she's talking about the possibility of her losing her job to AI. I mean, if a Harvard Med School student is concerned about job prospects, what hope do the rest of us have, right? But that's just, what do consumers think?
So that's not the top story right now for consumer sentiment, but only because we haven't seen any changes since the war.
Okay.
But it's unambiguously the case. It's very clear that over the past year or so, year and a half, consumers see that the labor markets have deteriorated substantially. The share of consumers who expect unemployment to rise in the year ahead is over 2/3, and it was half that at the beginning of 2025, I believe about half that. And so it's very clear that consumers believe that labor markets are much weaker now than they were at the beginning of 2025. We see that also in income expectations. Those have been pretty low. It may not matter if unemployment rates are going up if you yourself are not personally affected. But when we ask people what's the probability you or your loved one will lose a job in the next 5 years, that's fairly elevated right now. It was actually a little bit higher at the end of 2025. It has come down just a touch, but it's still near the upper end of its range. So consumers are worried. And last year they were worried more about tariffs. This year they're more worried about AI. But unambiguously speaking, consumers believe that labor markets have weakened, but they don't think it's gotten differentially worse after the Iran conflict started.
And also, just on this final note, you wrote demographics across age, income, and political party all posted negative sentiment or worse sentiment. Now, when all categories are behaving in the same way, how is that fundamentally different than, let's say, just one category by income or age or political party?
People can, disagree on what's going on in the economy for lots of different reasons. People I've already mentioned how across the wealth and income distribution, people are having different experiences with the economy. So, I think it's important to look at that. And what's really interesting about these recent trends after the start of the Middle East conflict is that everybody agreed. There was a consensus. Even people who generally feel stronger about the economy felt worse about it after the conflict began. And across the political spectrum, that's really important as well. So this deterioration isn't just partisan flag waving by people at one end of the political spectrum. Independents, Republicans, and Democrats alike all see a worsening in the economic outlook.
Finally, what are you looking out for in terms of data releases, economic developments that you're personally watching for development?
Yeah, I think the big thing is how much our gas price is passing through to the prices of other things. I think that is the number one thing that is going to be on consumers' minds and will influence consumer behavior. Right now, they are bracing for an increase in inflation. And is that actually going to happen? The worst case scenario that they were fearing back last April with the Liberation Day tariffs, that didn't end up coming to pass, and consumers pretty much immediately started updating their views of the economy. So another year, a different shock, but is it a long-term or a short-term shock? That's what I'm watching.
Thank you very much, Joanne. Thank you for your update. Where can we find more information about your work?
Go to my website, www.joannehsu.com.
Okay, we'll put the link down below. Make sure to follow Joanne there. Thank you again. We'll speak again soon. Take care for now.
Thank you.
Thank you for watching. Don't forget to like, subscribe.